we got to talk about interest rates. We got to talk about interest rates and the 10-year. Interest rates went up yesterday. So the government shutdown was averted for what do we buy? 45 days or something like that. And I think bonds were kind of holding back ahead of the weekend and because they were like, what's going to happen with that? And then once that got averted, bonds went back to going, the yields went up. When yields go up, interest rates go up. So our prior high uh, our prior recent high was 7.65, and yesterday we closed at 7.61. And unless something radical happens at the end of today, I can almost guarantee you we're going to pass the 7.65 number again. Because when you look at, thank you, Mortgage News Daily, for that number. When you look at the 10-year Treasury, and we're going to get into this a little bit more detailed here, but when you look at the 10-year Treasury, this morning at 8:45, we are at 4.729. 4.729. I told you on this channel that once we passed 4.34, it was off to the races. Resistance is broken. It was going to be a big break to the upside, so to speak. And now we're at 4.727. Wow. And it's just racing upward. This is a startling chart. Let me see if I can bring this up here for you. That's the 5-day. Let's look at the 1-month chart. The 1-month chart on the 10-year Treasury. There it is there. Can you spot the trend? Can you see the trend in the 10-year Treasury? Yeah, I can kind of see a trend. I detect a trend. Yeah, so that's what it is. Jack, why are interest rates continuing to go up? And why is the 10-year Treasury? Remember that the 10-year Treasury effectively sets interest rates. There is a spread between the two, but one follows the other. Interest rates usually follow the 10-year Treasury fairly closely because they're similar types of debt category. Now, I thought this was a very interesting tweet that I read the other day, and or this morning, I should say. Bank of America has a chart of rates. I think this is kind of a joke, but really it's not. A chart of rates going back to 3000 BC. And it says that rates are coming off 5,000-year lows. Remember that if it's going back to 3000 BC plus the 2000 we just had, that's a 5,000-year chart. And, I'm saying a little tongue-in-cheek here, but effectively, yeah, you get the point. We had the 1970s where rates went up to, when I was, a young person delivering newspapers, the best job I ever had, except for this one, 18%. And of course, we had the almost zero interest rates of the past 15 years or so. And now they're coming off 5,000-year lows. We were also at 5,000-year lows in the 1930s. That was the Depression. Your grandparents might have told you about it. So, or my grandparents did at least. Why is that? Why is this happening? And why do we expect more and higher interest rates for a lot longer, notwithstanding what the Fed has said? Why is that? The number one and number two reasons, you've heard me kind of allude to this, and there's a great article which I'm going to bring up for you in just a second. You've heard me allude to this on this channel before. And the reason is, number one, most of the federal debt is borrowed at 76-month increments, which is basically we'll just call it 6 years. And most of that federal debt needs to be rolled over in the semi-near future or paid off. They don't have the money to pay it off, so they're going to have to refinance it at a higher rate. It's as if the entire federal government has an adjustable rate mortgage. That's a really good way to think about it. And they've been paying like 3%. And now they're going to have to refinance at a lot higher. It's kind of like the 2008 bubble where, in that great movie, The Big Short, the adult entertainer owns 5 multifamilies down in Florida. That's a great scene. And she realizes that her mortgage payment is going to go up on one of the properties. And then the guy says in the movie, no, it's going to go up on all of the properties. And she defaults on all the properties because she can't keep up with the higher adjustable rate mortgage because mortgage rates are going to go up. And that's going to happen for the entire federal government. It's like the entire federal government can't afford the new rate on the adjustable rate mortgage. It's like 2008 supersized. And additionally, the federal government plans to borrow another over the next 3 years. Let me get to the number out of here. It's a staggering amount of. Let's just call it right now a boatload of additional numbers, not money. So between 1990, this is from what's his name at the Manhattan Institute, Brian Riedel. Excellent piece here by Brian from the Manhattan Institute. It's on CNN.com. Between 1990 and 2001, the average interest rate of the federal government paid on its debt declined from 8.4 to 1.7 due to dovish Federal Reserve, sluggish economy, and rising global savings. This allowed Washington politicians to hike debt held by the public from $5 trillion to $25 trillion. Because if you're paying 1.5% or 1.7%, that's almost like nothing for interest, with annual costs for interest remaining near about $350 billion, adjusted for inflation. However, as long as the interest rates kept falling or were almost zero, Congress could keep adding debt without raising interest costs. It was a beautiful thing if you were the government. And those stable interest costs became increasingly affordable as the economy and tax revenues rose, because as your productivity goes up, you can afford the loan. But over the past several years, politicians, he says progressives, but I would say the Uniparty, have been treating interest rates as an immutable law of science, that they're always going to be like 1 or 2%. And that the new spending just kind of just added on to it, just became a habit. Ooh, this does sound familiar. Now, as I said, most of the bonds out there have only a life of 76 months on average. And they have to be replaced with the new bonds within a decade. Plus, over the next 3 years, over the next 3 decades, I should say, we are planning to spend and borrow on another $119 trillion, pushing the debt towards 200% of the economy. So if you didn't understand exactly what that meant that we're totally bleeped unless we can become like reinvent the internet or something. We're going to need some type of massive productivity AI thing, I don't know, to keep up with these debt payments to put ourselves massively more competitive than the rest of the world, or our interest rates are going to be not higher for longer, but much higher for longer. We are definitely looking like we're going towards a place where interest rates are going to be much higher for longer. Plus, if the Fed gets its way, their whole idea is to slow down the economy, to cause a recession, to slow down inflation. But sometimes that doesn't work. Sometimes they slow down the economy and you still have inflation. What I call, as a reference to the old Let's Make a Deal show, which only had 3 doors. But in this show, it has 4 doors, in which case it's behind door number 4 is stagflation, which is inflation with a recession. Oh boy, complete disaster. But it does seem, and this is what's pushing. I mean, this is what's really pushing is this federal debt situation, and that basically they all have to refinance. It's effectively like an adjustable rate mortgage for the federal government. Instead of locking, what they should have done, which is what maybe a lot of you did, they saw that low interest rate over the last many years, and you locked in if you got a mortgage in 2000, let's just say 15, you locked in at 3% for 30 years. Why? Because you're not stupid. Why didn't the federal government do that? You can answer that question. You can finish that sentence for me, right? Why didn't they lock that debt in at the low interest rates? Instead, they bought debt for only on average 6 years. And now they're going to have to refinance it at much higher rates, which brings us to the fact that bond yields are going up. And with bond yields going up, interest rates go up. The other day I tried to bring this story up and it just didn't bring up. So I think we can bring it up now. We're not going to play this video for you, but last week, the chief economist at Zillow said the housing market is frozen up. Zillow's chief economist on rates. And again, what she's saying is what I've said to you before, is effectively people can't afford to sell because if they sold, they would maybe downsize, for instance. But the new smaller house is the same payment as the existing big house. So why do it? Doesn't make any sense to sell because the interest rate has gone up. And I think I even said this, yes. And buyers can't afford to buy when interest rates are, 7.5 or more, which looks like where we're going.